US-listed China ETFs jumping overnight after China's central bank said it would cut banks' reserve ratio requirements. Sam Vadas has more. To what degree is this going to stabilise the economic situation, Sam?
Well, I think it's clearly a sign now of the policymakers' intent to mitigate some of the slowing economy, Shri. It is the second one we have seen this year, of course. Now the banks, how much they will have to hold in reserve will be cut by 50 basis points, freeing up some $188 billion. This will apply to banks that don't have a triple R of 5%, but after that reduction, the weighted average will be around 8.4%. This will take effect on December the 15th, which is next Wednesday. Not many economists were really expecting this to come so soon. They were looking at around early February, but it did come after Premier Li Keqiang, of course, did flag a timely triple R cut last Friday. The PBOC's latest monetary policy report also hinted at some more economic support. Now, the central bank has said this latest cut will help bring down the overall financing costs. It did reiterate, though, its prudent approach to monetary easing, saying it'll keep liquidity at a reasonable level, but it certainly did emphasise that this measure will be largely to help support some of those smaller businesses. Of course, last time the PBOC did make a triple R cut was back in July, which had raised some concerns about the economic recovery at the time. But since then, of course, China has been facing a new set of challenges with this energy crunch, the slowdown we've seen certainly in the property sector, and also China still seeing small flare-ups of COVID cases as it does really maintain this zero COVID approach. So policymakers are no doubt hoping that this latest triple R cut will help propel that economic growth towards that at least 6% growth target that they are punching for. But of course, some growth forecasts, I should say, have also been cut to below 5%. But in terms of the market, they do say that a triple R cut is likely to boost investor sentiment, certainly in the short term, and support some of those valuations. But of course, economists are still cautioning that some of these other long-term, goals of the government, decarbonisation, this common prosperity, are all things that still could weigh on investor sentiment.
Absolutely, in the longer term, but it seems to be deliberate action here to slow down the economy.